Gold just shattered $4,580 an ounce. Brent crude is trading north of 113 bucks, and headline inflation, it just spiked to 3.8%. Right now, the Federal Reserve is completely cornered by a historic geopolitical crisis. And honestly, the mainstream is largely ignoring just how severe this macro shock really is. But today, we're going to break down the exact data driving all this chaos, look at how the new Fed chair is literally ripping up the old playbook, and crucially, we'll go over the exact specialized strategy you need to defend your portfolio right now.
So let's look at April 2026. Headline inflation hit an agonizing 3.8%. That is a painful three-year high, and it pushes the Fed's 2% target line completely out of reach. Now, this sudden spike, it isn't an accident, and it's definitely not random. It's the direct result of surging energy costs that are actively bleeding into housing, utilities, and transportation. We are dealing with a severe supply-side shock here. It's rapidly eating away at consumer purchasing power and, frankly, forcing the entire market to completely reprice risk.
And the root of this shock is undeniable: $113. That is the price of a single barrel of Brent crude right now, with West Texas Intermediate trailing just behind at 105. This isn't just some number flashing on a ticker. This is a catastrophic energy tax on global growth. It dictates everything, from maritime shipping freight costs all the way down to domestic manufacturing. When oil breaks 100 bucks and actually stays there, it drags down global GDP and pushes inflation higher at the exact same time. But to understand why oil is sitting at $113, we really have to look at the geopolitical map. The situation over there deteriorated with terrifying speed. In late February 2026, international negotiations completely broke down. By March, a U.S. naval blockade was initiated right across the Strait of Hormuz. And by April, a staggering 2 million barrels per day of crude were completely halted. Just to put that into perspective, the Strait of Hormuz is a critical choke point that handles roughly 30% of the world's seaborne petroleum trade. When you sever a third of global supply overnight in an active conflict zone, the economic shockwaves are immediate, they are severe, and they are incredibly difficult to reverse. Now, before we look at how the Federal Reserve is handling this unprecedented crisis, I do need to pause for just a moment to remind you that all investments involve substantial risk, illiquidity, and potential loss of capital. Past performance does not guarantee future results. Securities offered on various platforms, including investments in real estate, are highly speculative. You should not invest unless you can sustain the loss of a total loss of capital. Always consult a financial advisor or a tax professional to assess the risks associated with investing in privately offered securities. Section 1. Warsh's new Fed Playbook. Rates are held at 3.75%. So how does the central bank actually respond to an active stagflationary test like this? Well, Kevin Warsh, the newly confirmed chair of the Federal Reserve, is flat out refusing to hike aggressively into a supply shock, but he's also absolutely refusing to cut. He's effectively throwing out the old central bank models. In fact, he literally dismissed the Fed's traditional favorite inflation metric, Core PCE, as just a rough swag. For those who don't know, that's basically institutional shorthand for a scientific wild guess. Core PCE traditionally excludes food and energy, which Warsh argues just doesn't give a realistic, grounded picture of underlying inflation during a massive structural energy disruption like the one we're seeing in the Strait of Hormuz. Instead of that, Warsh is pivoting to a completely different framework: trimmed mean and median inflation. Basically, a trimmed mean metric systematically filters out extreme short-term price fluctuations. We're talking statistical outliers like a sudden 30% spike in oil prices to isolate the true permanent underlying inflation trend. It essentially just chops off the top and bottom extremes of the dataset. He's trying to cut through all the geopolitical noise of the energy shock so he can find the actual structural inflation signal underneath. And guys, this represents a massive paradigm shift. The old playbook? It relied heavily on flexible targets and constant forward guidance, basically telegraphing every single move to the market months in advance. But the new Warsh playbook, he favors those trimmed mean data points, an uncompromising strict 2% mandate, and absolutely zero forward guidance. The dot plots are effectively dead. He's bringing a strict, almost mechanical discipline back to the central bank, operating entirely on incoming data rather than making future promises. Section 2. The AI market bifurcation. The S&P 500 holds at 7,200. Now, with an active naval conflict, $113 oil, 3.8% inflation, and a rigid Fed chair, you would probably expect the stock market to be collapsing, right? Yet somehow, the S&P 500 is miraculously holding near 7,200. The answer to why is all in the first quarter of 2026. Tech and AI sectors posted a staggering 27.7% year-over-year earnings expansion. Meanwhile, the broad market and traditional consumer-driven sectors, they are completely flatlining or moderating under the heavy weight of those high energy costs. So the overall market actually isn't rallying. Rather, a highly concentrated handful of technology companies are financially carrying the entire S&P 500 on their backs to offset the macroeconomic drag of stagflation. And the catalyst driving that specific tech growth? $720 billion. That is the projected 2026 capital expenditure boom purely for hyperscaler AI infrastructure. We are talking about the physical, real-world construction of data centers, servers, and the massive power grids required to run artificial intelligence models. It's a massive, structural supply-side productivity boom, and it's happening at the exact same time as a global energy crisis. It is quite literally the ultimate tale of two economies.
So, here's the crucial question. How do you actually defend your portfolio when inflation is spiking, the global supply chain is fractured, and market growth has narrowed down to just a few AI infrastructure stocks? It requires a total rethink of asset allocation. Now, before I unlock the exact data-backed strategy you need to protect your capital, take one quick second to click that subscribe button below. We synthesize complex macro data into actionable explainers exactly like this one every single week.
Section 3. Specialized Portfolio Defense. The Focus Strategy.
In a stagflationary, highly bifurcated market like this one, broad passive diversification is actually actively hurting you. The old just buy the whole index approach leaves you dangerously exposed to the lagging sectors of the economy. To survive this, institutional capital is pivoting hard toward a very specific structural approach. Using commercial real estate as a prime example, the institutional data is empirical and undeniable. Broad, diversified portfolios are suffering from what's called a diversification discount. They just get dragged down by underperforming sectors. Meanwhile, specialized REITs, the ones focusing entirely on one specific asset class, are actually trading at massive valuation premiums. The precise execution of the focus strategy is pretty simple. You target single property type assets. Why? Because it allows you to leverage deep, specialized operational expertise. Look, in a volatile market, you want the operator who only does one thing, but does it perfectly. This allows you to entirely avoid that diversification discount we just talked about and utilize true idiosyncratic risk management. You're intentionally isolating the exact asset you want to hold, much like Kevin Warsh is isolating the exact inflation signal.
Institutional investors figured this out a long time ago. They prefer to make their own diversification decisions using narrowly focused REITs. Capital is reliably and swiftly withdrawing from diluted multi-sector funds. Investors just want pure play exposure. If they want exposure to the AI boom, they go buy a highly specialized data center fund. If they want supply chain logistics, they buy pure logistics. They absolutely do not want a watered-down fund that blends winners and losers together. In 2026, extreme specialization is your ultimate portfolio defense. The bottom line is this: the old playbook is dead. You can no longer rely on broad market momentum to save you from $113 oil and sticky 3.8% inflation. You have to protect your capital with absolute focus and targeted specialization. Now, if you want to understand exactly where that $720 billion of AI infrastructure capital is flowing and how you can position yourself directly in front of it, click the explainer on your screen right now. We do a full, comprehensive breakdown of the 2026 AI infrastructure boom. Click to watch it next and get your portfolio ready.